Across the country, millions of SUVs now sit in silent rows on dealer lots, unsold for months as inventory balloons to nearly 3 million units, double what dealers can move at current sales rates. Backlogs such as 41,000 unsold Ford Escapes and hundreds of zero-mile SUVs entering wholesale auctions offer stark evidence that demand has collapsed under the weight of record-high interest rates and plummeting resale values. What forced even the most popular segment into oversupply, and why is this only the beginning of a bigger crisis for the SUV market heading into 2026? An unsold tide of SUVs is piling up on dealer lots across the United States. By late June 2025, the number of new vehicles on dealer lots reached 2.8 million. That figure climbed to nearly 3 million by October, according to daily scrapes of dealer inventories from Cox Automotive and the Hague Report. The industry-wide days supply, a measure of how long it would take to sell all vehicles at the current sales pace, stood at 82 days in June and rose to 90 days by December. For context, industry analysts generally consider 60 days supply to be healthy. Anything above that means vehicles are not moving as quickly as expected. National databases aggregating listings from nearly 17,000 franchised light vehicle dealers confirm the scale. In June, that worked out to roughly 165 new vehicles per dealer. By November, the average had risen to 175 units, and some estimates put it as high as 185. While these numbers include all new vehicles, SUVs and crossovers make up the majority, over 60% of the total mix by late 2025. For many high-volume brands, that means 100 to 150 SUVs per dealer, with some stores reporting even higher counts as model year 2026 shipments arrive. Physical lot surveys and telematics data back up the national picture. In the Midwest and Southwest, regional field counts found individual dealers with more than 200 SUVs parked at a single location. Average days on lot for these vehicles often exceeded 80, with some stores holding inventory for 3 months or longer. One dealer said they were sitting on more than 80 days of SUVs when normal is 45 to 60. The scale of the buildup is not confined to a single region or brand. Whether in urban centers or small towns, rows of unsold SUVs now stretch across dealer properties. At the same time, auction lanes have begun to see a steady flow of zero-mile and nearly new SUVs, vehicles that never found a retail buyer and are now being liquidated at wholesale. Mannheim and Odessa auction data confirm an uptick in late-model SUV volumes, with sell-through rates lagging historical averages. This accumulation is not a statistical anomaly. It is the result of months of rising inventory, slow sales, and a steady influx of new models. Dealers now face a complex inventory picture, with more than 3 million new vehicles in stock nationwide and SUVs dominating the excess. These numbers set the baseline for understanding the pressure building across the entire SUV segment. An unprecedented glut of SUVs is sitting unsold on dealer lots. Ford Escape inventory reached a 353-day supply in October 2025, with over 41,000 units unsold nationwide. The Lincoln Aviator, another Ford product, held 191 days supply, more than 8,400 vehicles, while Volvo XC40 stock sat at 211 days. These are not isolated cases. Car Edge data highlights a cluster of mainstream SUVs where aging inventory is now measured in quarters, not weeks. Dealers describe entire rows of Escapes and Aviators parked for months, with sticker prices unchanged and test drives rare. The pressure is most apparent at the model level. Ford's compact Escape, once a volume leader, now lingers on lots far beyond industry norms. The Aviator, positioned as a premium midsize SUV, faces nearly 6 months of unsold vehicles. Volvo's XC40, a compact luxury crossover, also sits unsold at more than double the typical day's supply for its segment. These backlogs reflect a mismatch between production and retail demand that cannot be explained by seasonality or regional slowdowns alone. As inventory ages, the consequences ripple beyond the retail channel. Auction houses such as Mannheim and Odessa have reported a steady rise in late-model SUVs entering wholesale lanes. In recent months, zero-odometer units, vehicles that never found a retail customer, have begun to appear in volume. These are not fleet returns or off-lease vehicles. They are brand-new SUVs, often with window stickers still attached, rerouted from dealer lots to auction blocks. Observers note entire auction lanes dedicated to unsold Escapes, Aviators, and XC40s, with sellers accepting bids well below original invoice prices. Sell-through rates at wholesale auctions have lagged historical averages, especially for these high backlog models. Dealers and remarketers describe a growing pool of near-new SUVs circulating between retail lots and wholesale markets, each time at a lower price point. The pattern is visible in auction data. More than 10% of late-model SUV entries in some lanes now show fewer than 100 miles, and many are flagged as never having been titled. This wholesale spillover confirms that excess supply is not contained at the dealer level. Instead, it is flowing into secondary markets, compounding price pressures and signaling that the oversupply problem is concentrated in specific models as well as the broader segment. The evidence is clear. The SUV glut is not just a matter of national totals or brand averages. It is visible in the outlier backlogs of models like the Escape, Aviator, and XC40, and in the growing presence of unsold new SUVs at wholesale auctions. These micro-level signals reveal a market struggling to clear inventory through traditional retail channels, forcing dealers and automakers to seek relief in wholesale markets, often at a steep discount. Automakers responded to the end of the chip shortage by restarting production lines at full capacity. By late 2025, U.S. new vehicle inventory had grown 21 to 22% year-over-year, outpacing any increase in actual sales. Factory planners at Ford, Hyundai, Mazda, and other brands scheduled output based on forecasts that never materialized, sending a steady stream of SUVs to dealer lots. Mazda's CX-5, for example, reached 137 days supply in October, with more than 34,000 units unsold. Hyundai Tucson inventory climbed past 51,000 units, holding at over 100 days supply. Even as some models like the Toyota RAV4 stayed leaner, the overall mix shifted heavily toward SUVs and crossovers, with these vehicles making up more than 60% of total new inventory by the end of the year. Product planning cycles locked in dozens of new and refreshed SUV models between 2019 and 2025. Dealers now face a saturated landscape, with every mainstream brand fielding multiple variants in the same segment. Honda, Hyundai, and Kia each list several compact and mid-size SUV nameplates, while Mazda's CX series alone accounts for more than 70,000 units in stock across the U.S. This proliferation has not only increased the total number of vehicles available, but also fractured buyer attention and eroded the uniqueness of individual models. The market now supports more than 90 distinct SUV and crossover nameplates, up sharply from a decade earlier. With so many trims, powertrains, and options in the pipeline, factories continued shipping vehicles even as dealer lots filled up. Model year 2026 arrivals compounded the backlog, as unsold 2024 and 2025 units remain parked. Inventory growth rates, confirmed by OEM shipping reports and national listing scrapes, show the supply engine running faster than the retail market can absorb. This dynamic set the stage for a new wave of inventory pressure, as vehicles built months ago began aging in place, waiting for buyers who never arrived. An inevitable wave of near-new SUVs is scheduled to hit dealer lots, regardless of whether buyers return. Captive finance arms at major automakers wrote hundreds of thousands of new SUV leases from 2022 through 2024. Most of those contracts run for 36 months, creating a defined wave of lease returns in 2025 and especially in 2026. According to Cox Automotive lease flow data, the volume of SUV leases written during the post-pandemic recovery was sharply higher than in the years immediately before. These vehicles were leased under aggressive incentives and optimistic resale assumptions, and they are now locked into the supply pipeline. No matter what happens with new vehicle demand, these near-new SUVs will return to the market on a fixed schedule. The same timeline applies to fleet purchases, and it drives fleet supply back into the market. Rental companies and large commercial buyers, having delayed acquisitions during the chip shortage, returned to the market in 2022 and 2023. Their orders favored SUVs and crossovers, reflecting consumer preferences and automaker production priorities. As these fleet vehicles cycle out of service, typically after 2 to 3 years, they enter wholesale channels and add to the glut of late-model SUVs available to dealers and used car buyers. This supply pipeline is not theoretical. Lease cohort charts from Cox and industry analysts show a pronounced bulge in maturing contracts beginning in the second half of 2025 and peaking in 2026. The vehicles involved are overwhelmingly SUVs, reflecting the dominant mix of new leases and fleet deliveries during the recovery period. Captive finance companies, including Ford Credit and GM Financial, have already flagged the scale of these upcoming maturities in their investor presentations. Once these SUVs return, they cannot be held off market indefinitely. Most will be routed through auctions, certified pre-owned programs, or direct-to-dealer sales, swelling inventory just as retail demand is projected to soften. The inevitability of this influx is built into the structure of the lease and fleet business. Vehicles leased or sold to fleets in 2022 and 2023 are already on the road. Their return is a matter of contract, not market timing. As a result, the inventory pressure facing dealers in 2025 is only the beginning. The real spike in near-new SUV supply is already scheduled for 2026, regardless of how quickly or slowly new vehicles are selling today. This pipeline is not just an inventory problem. It is a structural market failure for the SUV segment. Oversupply, accelerating depreciation, high interest rates, and weak resale values will force deeper discounts and sustained dealer inventory pressure as lease and fleet returns converge in 2026. Expect slower turn rates, tighter margins, and continued downward pressure on used values. That is the broader warning this sends about the SUV market. Average monthly payments for new SUVs have climbed steadily, tracking the rise in interest rates since 2022. According to Experian, the typical annual percentage rate on a new vehicle loan reached 7% by late 2025, compared to just 4% 3 years earlier. For a $45,000 SUV financed over 60 months, this shift translates from an $830 monthly payment at 4% annual percentage rate to $891 at 7%, an increase of more than $60 per month, even before insurance or taxes. That difference alone can push many buyers out of the market, especially as wages have not kept pace with the cost of borrowing. Industry sales data confirm the impact. The seasonally adjusted annual rate fell to 15.3 million in June 2025, the lowest level since late 2023. This drop is not simply a seasonal dip. Lender credit application volumes for new SUVs have declined, and intent-to-buy metrics tracked by Cox Automotive and TransUnion show fewer shoppers starting the purchase process. Google search trends for top-selling SUV models also softened through the second half of 2025, mirroring a broader pullback in big-ticket spending. Dealers report that even moderate price cuts, $1,500 or $2,000 off sticker, do little to offset the burden of higher interest rates. The payment math remains stubborn. As annual percentage rates rise, the monthly cost stays high regardless of discounts. Buyers who might have stretched for a new SUV in 2022 are now pausing or shifting to used vehicles, smaller segments, or simply waiting. The result is visible in both showroom traffic and closing ratios. With fewer buyers willing or able to absorb these higher payments, excess inventory accumulates. This demand break completes the chain that began with oversupply, locking unsold SUVs onto dealer lots and setting up the next phase, a slide in wholesale prices as inventory continues to age. Used vehicle inventory across the United States reached 2.31 million units by early December 2025, holding at about 50 days supply. This marks a 6% increase over the previous year, with SUVs making up a growing share of the total. The influx is not limited to off-lease returns. Auction data from Mannheim and Odessa shows a steady rise in nearly new SUVs, including models with less than 100 miles running through wholesale lanes. These vehicles often come directly from dealers unable to find retail buyers, and their presence at auction signals a change in how excess inventory is managed. As more late-model SUVs enter the wholesale market, prices have softened. The Mannheim Used Vehicle Value Index for SUVs shows double-digit % declines in recent months, outpacing drops in other segments. This downward pressure is reinforced by captive finance companies issuing residual value bulletins that cut projected end-of-lease values for several SUV models. These adjustments make new leases more expensive and accelerate depreciation for vehicles already on the road. The feedback loop is clear. As wholesale prices fall, lenders and remarketers lower their expectations for future resale value. This, in turn, prompts more aggressive pricing at auction and further erodes the value of used SUVs. Dealers find themselves squeezed, unable to recover costs on trade-ins or off-lease vehicles, and forced to accept lower bids just to clear aging stock. The result is a market where price deterioration feeds on itself, with each new wave of used inventory reinforcing the cycle. Dealers pay for every day an SUV sits unsold. Most new vehicles are financed on what is called a floor plan loan, a line of credit that covers inventory until each car is sold. For a $40,000 SUV at an 8% annual interest rate, holding that vehicle for 90 days racks up about $800 in interest alone. That is before counting insurance, lot fees, and reconditioning costs. Every extra week on the lot chips away at the dealer's profit, especially as gross margins shrink with each passing month. General managers face a tough choice. Some stores move quickly to discount aging SUVs, slashing prices by thousands just to break even before floor plan interest wipes out any gain. Others hold out, waiting for factory incentives or hoping for a late-season surge, even as costs pile up. The result is a split in strategy: rapid markdowns to clear inventory versus a gamble on delayed discounts. Both carry risk. Heavy discounters can reset local market prices downward, while those who wait risk even deeper losses if wholesale values drop further. Dealer profit and loss statements show the pressure in black and white. With acquisition costs locked in and carrying charges rising, the profit window narrows month by month. For high inventory models, some dealers now lose money on every transaction, forced to choose between a quick loss and a slow bleed. Wholesale weakness on SUVs filters through to retail, shaping every decision on the lot. Model year 2026 SUVs now account for 60.3% of all new SUV inventory in the United States. This concentration is not accidental. Product planning cycles locked in these builds years ago, and factories continued shipping new units even as unsold 2024 and 2025 models remained on the ground. Dealers face a landscape where the majority of their SUV stock is tied to the latest model year, but the backlog of prior years is far from cleared. At the same time, interest rates remain elevated. Floor plan costs for every unsold vehicle have not eased, and the monthly payment for a new SUV still reflects the higher cost of credit. With no sign of a rapid drop in borrowing rates, the affordability problem stays locked in. Even as manufacturers consider pulling back on production, the vehicles already in transit, especially the model year 2026 wave, are now a fixed liability. Industry projections show that if current conditions persist, dealers could be holding more than 100 days' supply of SUVs by the second quarter of 2026. Price pressure is not theoretical. As the model year 2026 mix dominates, unsold inventory ages in place, and every extra week on the lot erodes dealer margins. For original equipment manufacturer planners and dealer principals, the window to act is narrowing. The combination of sticky rates and a heavy model year 2026 carryover sets up a high-pressure scenario with the risk of deeper discounting and forced liquidation if retail demand does not recover. The broader warning is clear. This situation points to a market failure in the SUV segment, driven by oversupply, rapid depreciation, high borrowing costs, weak resale values, and mounting dealer inventory pressure. Unless demand recovers, the coming months will likely bring more discounting, more forced sales, and greater losses across the distribution chain. Today, nearly 3 million new vehicles sit idle on dealership lots, while high interest rates and lease returns are driving inventories higher. As automakers brace for 2026, oversupply now signals a structural shift, one where old assumptions about SUV demand no longer hold. Inventory is piling up because dealers ordered aggressively after shortages, production recovered, and lease returns accelerated. Demand collapsed as buyers reacted to higher financing costs, weaker resale values, and lower willingness to trade up. Dealers face intense pressure to move stock, leading to deep discounts or to holding vehicles longer. Both outcomes accelerate depreciation, weaken resale values, and compress dealer margins. Going into 2026, the situation can worsen because current production schedules and orders will arrive when demand remains soft. Interest rates may stay elevated, and resale values may fall further. This is a market failure, not a car review. It is a structural warning that the SUV market may be overbuilt, that margins will tighten, and that manufacturers and dealers must change production and pricing strategies. How we respond now will shape the future of the auto industry. What is your view on this turning point? Share your thoughts below.